Welcome to the big interview on today's edition of Money Life. Joining me now, Barry Martin. He's manager of the Shelton Equity Income Fund. That's EQTIX if you want to look it up for yourself. If you want to learn about the firm, you're going to go to sheltoncap.com. If you want to learn about the fund and its sister funds, you're going to go to sheltonfunds.com. Barry Martin, it's great to have you back on Money Life.
Thanks, Chuck, for having us on. Appreciate it.
Now, equity income strategies do a lot of different things, but you guys are involved in sort of covered call and option strategies. And that's part of why I wanted you on the show, because anybody who's doing covered calls and options is usually doing it about risk mitigation. But we've been in a range-bound market for a while, and the risks are a lot of the extraneous, hard to tell risks. They're the what if Congress doesn't get its act together kinds of risks. What happens if war in Ukraine, doesn't kind of get the right resolution or whatever, those kinds of risks, more than they seem to be just the day-to-day, what the market's doing. So help us understand what you see as the big risks out there and what that does when you're putting together what you want to invest in, given the strategy you pursue.
Yeah, I think to look at what we do basically on a 10,000-foot level is we're generating additional cash returns by monetizing the volatility of the underlying equities. And we do that by selling covered calls. So covered call writing, if we go back, back in the days, like what exactly it is, it's basically you're selling someone the right, but not the obligation to purchase the stock off you at a predetermined price. So if Apple is roughly around 170, I can sell someone the right to buy Apple off of me in the future at a higher price, and someone's going to pay you for that right. So the stock's at 170. I can sell the July 185s. So that means in July, someone's going to offer us to buy Apple off of us at 185. And someone's going to maybe pay us $3 for that right to buy one share of stock of us at $15 higher than now. And so with volatility where it is now, that basically means there's more unknown. We don't know what's going to happen with Ukraine. We don't know what's going to happen with the debt ceiling. There's a lot of unknowns up here, and the more unknown that band or volatility widens or expands. And so, when the volatility in the VIX, and a good way to look at volatility is looking at the VIX. So when the VIX was at 9, maybe those 185s were only $1. But with the VIX now currently in the high teens, now we're looking at $3. So this expansion of volatility and these unknowns and what's happening actually helps out strategies like this when you sell covered calls, because now we're getting $3 instead of 1. And now what happens is come July, if Apple never reaches 185, we put that $3 in our pocket, and then that's part of the income. We also get the dividend that's being paid, so that's more income put in the pocket. Now, if it never gets to 185, we do that trade again. Then we might sell the August or September 185s. But it does get to 185, then we have the decision to make. Do we buy the option back, or do we let it get sold, where we let that person who bought the option off at 185, do we let that person buy it from us? So we look at the strategy, and we feel you can win in three basic different ways. One, you can win on the option premium, basically that $3. You can win on the dividend that's being paid. And you can also win where you get some upside, where that stock goes from 170 to 185. And since, as you mentioned before, we're in a range-bound market, seems pretty much we're 3,800, 4,200 on the S&P. We're constantly selling away these upside calls that are not getting to that point. So our return numbers are pretty good. I mean, last year we're down about 9% compared to the market at 18%. And that 9% differential is that option premium. It's that $3 that we're selling every 45 to 60 days, and that we're putting in our pocket. So to long-winded, answer your story, but basically by these type of strategies, selling away upside, monetizing the volatility position, it really works in your favor. And that's why, a lot of people are starting to use these strategies, unlike them before.
The other side is we've got a market, because it's range bound, that has a lot of volatility without direction. Does this work better when there's not direction? And if you had to look at the direction we're likely to see next, what direction do you think that is?
Yeah, this type of strategy does very well in a range-bound market, because basically you're in this choppy to sideways market. And so by selling away the upside, you're taking those wins and put in your pocket. Where this type of strategy doesn't do as well is a dramatic appreciation. Now, once again, we go back to your example, or my example of when the Apple was at 170 and you're selling 185. If Apple runs to 200, you don't get that upside from 185 to 200. You're basically capped at 185. So it underperforms in dramatic upward markets, but we're not in that environment right now. Some sectors are, obviously, technology has done very well year to date, and that is, for various reasons, mainly due with AI, and also it's become more of a defensive play, some technology, especially software. But, going forward, what do we see? Do we see the market appreciating another 10 to 20%? Technology's already gone up over 20%. Is it going to get 30, 40, 50% this year? I don't think so. I think we will continue in this range market, and that mainly has to do with what the Fed's doing. A couple of weeks ago, a lot of people believe the Fed is done, but even this morning, we're looking at what the Fed, possibilities are, and there's now a 30% belief that they're going to continue hiking into this market. Which who would have thought? Going back a month, especially with the regional bank financial crisis that we're in the middle of. But it still seems like we're not done with inflation. The Fed still has its foot on the brake, not the gas. So I don't see that much upside here going forward. I still believe we're going to be in this range bound market, which continues to be between the 3,800 and 4,200 on the S&P.
So, and I mean, range bound. I guess the second side of that is, they always say when somebody makes a forecast, you're looking for what they say it's going to happen and then when. You got to have those two things. How long? Is it just a matter of we're range bound until something breaks and the Fed responds, or the Fed responds because it thinks it's fixed?
Yeah, I mean, that's a good question. I mean, you don't really know. I mean, at the beginning of the year, who would have thought the Silicon Bank and First Republic would go under, right? I mean, I didn't think that was a possibility on January 1st. First Republic is my bank, being located here in San Francisco. And that was not on the horizon for me. So you really never know what's going to happen. But even that didn't deter the Fed, which I find, it's unbelievable. But that's how focused they are on inflation. Personally, it's one of those things that I would say, hey, something big has to happen. But we had that, right? And the market still was up this year. So it's hard to say, but I still like the old adage of, hey, don't fight the Fed, right? So until the Fed reverses course, I still think we are in a sideways, choppy market. Some sectors will do better than others, but overall, I still think it's appropriate to have this type of strategy where you're selling away upside and selling covered calls. I think that definitely makes the most sense, and especially where volatility is now. With volatility in high teens, basically you're selling that vol and you're generating those additional cash returns by selling these covered calls.
Obviously, you're talking your book here.
Yeah.
And nobody should be surprised by that. That's your job. But if somebody's going to add a covered call fund, and I'll point out, Tom Lydon of Vetify made a covered call ETF, his ETF of the week, on this show a day ago. But if somebody's going to look at this strategy, does it play nice with others? I mean, am I getting rid of my equity income fund to bring yours in, or am I using yours to supplement the one that's already there? Because it's not like you're in a space where somebody's going to look at their portfolio and go, oh, no, I got nothing there.
Yeah, that's a great question. Our clients, which are advisors who manage money for their end clients, the advisors that we talk to are moving away from your traditional 60-40 portfolio, 60% equity, 40% fixed income. And what they're doing now is basically taking a slice of their equity exposure and a slice of the fixed income exposure and forming a new slice of the pie, basically 20%. And it's going to strategies like ours. Morningstar created a new sector for us, or section. It's called derivative income. And derivative income had the third most inflows last year of any category on Morningstar. So it's becoming way more popular. It's becoming more the norm. And basically, it's forming a new sector where it's in between fixed income and equities. It doesn't exactly perform like an equity strategy. It has similar returns to equities with 25% to a third less standard deviation. So lower risk there. And then on the flip side, on the income side, it generates similar income to like a junk bond. But on the flip side, you don't have to worry about the credit risk on that side. So it's interesting how people are using it, but it has a different return pattern. And when you add a different return pattern to one's overall portfolio, you're lowering their overall risk. So it's really starting to play and make sense as a smaller slice than one's pie. And that's how we're seeing it being used.
And it's an interesting take, an interesting addition to a portfolio, and it's also kind of an interesting strategy given what you're seeing happening in the market. Barry, thanks so much for taking the time to talk with me.
Thanks, Chuck. Appreciate it.
That's Barry Martin. He's the manager of Shelton Equity Income. It's EQTIX, the ticker symbol. SheltonFunds.com to learn more about the fund. SheltonCap.com to learn more about the management company. And up next, because we just passed the halfway pole on today's show, we're going to be talking technicals with Ed Moya of Owanda. So stick around. We're living the money life, and we're right back at it in just a moment.